Welcome to the Wirex weekly crypto podcast, where we dive into engaging conversations with experts, thought leaders, and innovators. And I'm your host, Lianna. I'm really excited to introduce our guest for today's podcast episode, Yves Renno, who heads up the trading department at Wirex. Welcome, Yves.
Thank you. Thank you very much, Lianna, for having me. And I'm really happy to share my experience with the audience today. Thank you very much.
Cool. Today, we will dive into one of the hottest topics in the crypto world right now, which is Bitcoin halving and the ongoing bull run. We are so back, right? Yves, could you explain to us what is Bitcoin halving and why is it significant for the cryptocurrency ecosystem?
Of course. Basically, after a halving event, the Bitcoin block production reward is divided by 2. And this event happens once every 4 years. And in practice, it translates into a 50% drop in the Bitcoin supply growth. So it's like a supply shock in the likes of, the oil supply shocks that we've had in the late 70s, for example. But people usually use the term shock to describe an event that is unexpected. And as far as Bitcoin is concerned, we know when the halving event will happen because we know it happens every 210,000 blocks. And we know that a new block is produced roughly once every 10 minutes. So the Bitcoin cycle is, really defined by these 210,000 blocks. And the cycle lasts 4 years. So the next halving is scheduled on April 20th. And the block production reward will drop then from 6.25 Bitcoins to 3.125 Bitcoins, so half of it. This drastic decrease in the supply growth typically reduces the market's selling pressure. You have less supply in the market, and it has a tendency to trigger a rally. And as you can imagine, its rally is always a major event in the crypto economy. Many projects in the sector, centralized or decentralized, design their business strategy and implement it over the 2 to 3 years that precede the bull run with one clear objective in sight, to leverage the bull run as much as possible. So it's certainly an exciting event for most of us.
Yeah, that sounds really exciting. What is the impact of the Bitcoin halving on miners, and how do they prepare before the halving?
It can be really a stressful time for miners because, halving the production reward, it could really hurt the miners' revenues. So miners basically receive Bitcoins and sell them in the markets within a year on average. So if there's a price rally around the halving event, it is actually a relief for them because they can sell their production at a higher price. Miners have obviously what we call a break-even price. It is a Bitcoin price level over which they can operate and generate profits. It is the price where basically revenue covers the cost of production. And after April 20th, after the next halving, the break-even Bitcoin price would be estimated around $40,000 or so. And as long as the market price of Bitcoin stays well above the $40,000, miners can reasonably continue to operate and make profits. So this break-even price depends on the energy cost, obviously, the hardware the miners are using to mine. There are pieces of hardware that are more efficient than others. And miners can improve their break-even price by upgrading their hardware. But to upgrade their hardware, they need to sell Bitcoins from their inventory because it's costly. They have to finance this upgrade. So having a rally now before the halving is actually a chance for them to cover more easily their upgrade costs. And we've seen miners gear up quite quickly now with the most advanced equipment and get ready for the post-halving period. Major miners actually started gearing up in the second half of 2023, but again, the timing for gearing up is important because you have more advanced hardware coming out very frequently. And a miner can't take the risk to wait for too long or wait for a potential Bitcoin pre-halving rally. Pre-halving rally is never a certainty. They just need to sell Bitcoins at a good price to finance the upgrade and enter the next cycle comfortably.
Wow, that's really interesting. And I never knew about this side of with the miners, right? Could you tell us more about Bitcoin mechanics and why does halving happen every 4 years and not 6 or 10?
I'll try to explain why, although, it's not necessarily my area of expertise. Still, I think that, any trader, any investor should really grasp the importance of the Bitcoin mechanics and use them to form a market view of their own. And to understand how the Bitcoin halving works and why it's been designed that way, I think we should go over some of the basics of the Bitcoin's block production. First of all, we mentioned that a new block is produced and added to the blockchain every 10 minutes. Producing a block means, finding a hash value that identifies this block. And the hash value, a hash is a 64-digit hexadecimal value that a miner must find using, complex algos that are CPU intensive, that are energy intensive. So this hash depends on the hash of the previous block, and it also depends on the contents of the block. So it depends on the transactions that are written in the block. We always mention that, Bitcoin is a ledger technology. It is a ledger where all transactions are written in the blocks. And it takes roughly 10 minutes to find a valid hash value, produce and append the corresponding new block to the blockchain. And this 10 minutes duration is stable. Again, every block production is currently rewarded with 6.25 Bitcoins, but the total Bitcoin supply has a hard cap at 21 million Bitcoins. This is something that, many of us know by now. There can be more than 21 million Bitcoins issued. So if miners were to produce blocks every 10 minutes and get the same reward of 6.25 Bitcoins every time, the protocol would just run out of Bitcoins in 4 to 5 years. So by dividing the reward by 2 every 4 years, we have a protocol that can reward block producers, not indefinitely, but for the next 115 years. And it can't go on forever because Bitcoin is not actually infinitely divisible. The minimum rewards can only be at or above the smallest unit of Bitcoin, and that is 1 Satoshi. And basically, the 115 years limit corresponds to the last cycle, the cycle where if we try to divide the reward by 2 once more, the reward would fall below 1 Satoshi. So it's not something that we can pay out. Next month, when we're entering cycle number 5, and the 33rd and last cycle is expected to end so in the year 2140 or so. So the idea behind this time frame of 415 years could have been to give, Bitcoin a very good chance to be adopted worldwide and mined in as many countries as possible, to give Bitcoin the time to be adopted.
I would like to think that Bitcoin would be adopted a little bit earlier, right? But is there a reason behind the choice of 10 minutes duration between 2 blocks?
Yes, I think so. The 10 minutes duration was probably picked for a reason, and at least according, to specialists and the emails we have from Satoshi Nakamoto and so on, the challenge behind the choice, the 10 minutes choice, was to give the miner a chance to learn about the latest block added to the blockchain in a timely manner. So we mentioned that the block is identified by a hash, right? And that the hash depends on the previous block's hash, but also on the contents on the block, so the transactions that are written in this block. So if miners are not informed about the creation of a new block in a timely manner, they could actually still be looking for a hash that depends not on the hash value of the latest block, but the hash value of an older block. And these miners would actually be running expensive algos on outdated information, which is, of course, an incredible waste of resources. So imagine the scenario where a block is produced, not every 10 minutes, but every minute. For instance, a new block is produced in the US, and miners in Kazakhstan receive the info about the new block within a 2 minutes delay. So these miners actually would still be running algos based on a hash that is 2 blocks old, because blocks are produced every minute and they get the info 2 minutes with a 2 minutes delay. So it would be a complete waste of hash power. Actually, the miners in Kazakhstan would be completely excluded from the production and the validation process, because they have literally no chance to participate in the process, because they would always have an outdated view of the blockchain. And this is a problem. It's a problem. It actually poses a security risk for the blockchain, because a smaller number of miners, concentrated geographically in the US, for instance, could gain control over the Bitcoin production. So imagine now the reverse. Imagine the scenario where a block is produced every hour instead of every 10 minutes. So, today finding a hash, it's like winning the lottery. So a country that runs a lottery every 10 minutes instead of 60 minutes improves the odds for a single person to win something by a factor of 6. Okay, so it's the same for mining, looking for a hash. Basically, if it's 10 minutes instead of 60, miners have more steady returns, better expectations for revenues, and if they are a bit persistent running their algos, they won't have to wait for ages before getting some reward. So increasing the block production time could discourage miners and favor the largest ones, the ones with more resources, more capital to buy the energy, the hardware needed to run the algos. And this scenario would just, compromise decentralization. So I think developers, probably wanted more miners to participate in the Bitcoin production. So the 10 minutes is a trade-off here. It's a trade-off that is supposed to promote diversification. But, I like to think of the 10-minute duration as, the Bitcoin's heartbeat. And every 210,000 heartbeats, we have a halving event.
I never knew so much consideration went into, the block production, and there's just so much to, unpack, right? And I love the analogy of the 10-minute duration as Bitcoin's heartbeat, and I may actually use that. And out of curiosity, when did the first Bitcoin halving event happen?
Well, it happened in 2012. So that was, 4 years, nearly 4 years after the first block was created, and that was in 2009. So the Bitcoin reward for block production was initially set at 50 Bitcoins, and it dropped to 25 Bitcoins. So after the first halving. And we'll never see the last cycle. Obviously, the 33rd cycle is supposed to happen in 115 years or so. So, maybe Satoshi Nakamoto would see it happen. I don't know. Because, according to Jamie Dimon, the chairman and CEO of JP Morgan, he mentioned in Davos 2 months ago that Satoshi could literally destroy Bitcoin once all the 21 million Bitcoins are issued. So, I don't know, would Satoshi come back from his grave and destroy Bitcoin? There must be quite a lot of faith there. I guess, for some people, Bitcoin has become a religion. And jokes aside, I think it's a great achievement for something many often dismissed. because of a lack of understanding. And I remember I took interest in Bitcoin after attending a speech by Andreas Antonopoulos in London back in 2015. So a friend invited me to join him there. And when you hear Andreas Antonopoulos speak, you already know that Bitcoin is more than technology. It's a strong political message, and it can speak to every generation, especially the new ones. To me, Bitcoin brings consensus against, the unhealthy competition that banks are running often at the expense of their clients. And this is what happened in 2008, 2011, where we had the subprime crisis, and we had the credit crisis in the EU, and the different sector bailouts, that were perceived again by Main Street as something they had to do to save to save the system because of a risk, an unreasonable risk that it's taken. And I think Main Street is still paying today for the poor management of the banking system. We can see it when we go to the bank. We do some basic operations. The level of compliance has grown significantly.
Yeah, and I think a lot of people have lost faith, right, in the banking system, but they are unable to get into crypto because of lack of understanding, as you said, right? So why did the Bitcoin halving trigger the major cryptocurrency bull runs historically? If the halving event is a certainty, shouldn't the price of Bitcoin already reflect this event?
Yes, of course. The halving event, as I said, it creates an imbalance between demand and supply. And when the supply drops, when the supply growth, the growth drops by 50%, and if demand theoretically stays the same, we could expect the Bitcoin price to rise sharply, reasonably, maybe by a factor of 2. In other words, the new supply-demand equilibrium price is set at a level that is significantly higher. So we have today roughly 6,300 Bitcoins issued every week as rewards for the miners, right? And they are added to the total available supply. A large portion of these 6,300 Bitcoins is sold again within a year. And after April 20th, this number will drop to 3,150 Bitcoins. So if the halving event were a complete surprise, we'd see an impressive price jump, a shock. The Bitcoin price could almost double within a short time frame. And it is really a shock. And again, a shock like we've seen on commodity markets, on the oil markets during the decision from the OPEC to rise, to increase, to reduce production in the late 70s. But the halving event is not a surprise at all. So normally expectations of future halvings should push the price higher progressively, smoothly over time. And I say expectations plural, so because we should not be considering only the upcoming halving events in April, but also all future halvings for the next 115 years or so. So the impact of all future halvings on the Bitcoin supply growth should theoretically be included in the price of Bitcoin today. And this is all theory, of course, and in practice, it's never that simple. There's always uncertainty around halving events. And for example, the first question that comes to mind, will it happen again? Will halving happen again, or will Bitcoin stay by then? So even if every indicator, every metric points towards a good probability to see Bitcoin survive or thrive, we are always looking for arguments to explain why Bitcoin could fail. And we are also looking for arguments to explain why a rally won't happen. Our decisions are usually hesitant and delayed as a result. So this time around, the rally seems to have started earlier than expected because Bitcoin ETFs were approved by the SEC in January, so exactly 2 months ago. So thanks to the ETF vehicle, investing in Bitcoin has never been easier than it is today. And naturally, the fear of missing out has also spread among institutional clients. And, the ease of investment through ETF vehicles with this fear of missing out, it's an exclusive cocktail. And this is probably why we have an ongoing rally right now.
Yeah, I mean, I love the fact that, you're always looking for arguments to explain why Bitcoin could fail because, if we've got to try to see from all sides, right? What do you think are the other risks that could favor or prevent a market rally post-halving?
Well, there are, certainly many factors that could trigger a market correction, for example, or at least, fuel what we call fear, uncertainty, and doubt. These three words, they form the infamous acronym FUD that we see usually in the press. So should we expect a severe correction before the halving event? The traders have a tendency to buy the rumor and sell the news. So we've seen it just after the ETFs were approved in January. And we've also seen, if we look back in history, we saw a price correction just before the last halving in May 2020. And we've also had recently a severe market correction of 14% last Tuesday from the highest price to the lowest intraday. A 14% correction when the first Bitcoin all-time high was surpassed this year. So reaching the all-time high, it's an important piece of news, obviously, and again, we have this tendency to buy the rumor and sell the news. I mean, there are other factors that could trigger a market correction. Obviously, we have miners. They could start dumping for some reason a large portion of the 2 million Bitcoins they still hold in their inventory. You have dormant holders. They could suddenly wake up and dump their holdings as well. We have the Mt. Gox bankruptcy proceedings. We're talking about a total of 200,000 Bitcoins that are expected to be redistributed, repaid, probably started already. And finally, we have the US government holding more than 200,000 Bitcoins that have been seized over the years. That's, it's nearly 1% of the total Bitcoin supply. So what are they going to do with these 200,000 Bitcoins? So we do have, a natural tendency to cling a bit to contrarian events, looking for reasons why the market would fall. And we do fall for what we call in finance, in behavioral finance, the confirmation bias. So we look for information that supports our view against the view of the crowd, against the odds, against reason sometimes. This is why Bitcoin rallies are anything but a walk in a park. It can be quite violent.
Yeah, there's just so much to consider. And, I have to say on a side note that I love the fact that you have, managed to include fear of missing out and also FUD, right, in this conversation. What about factors that favor the market rallies?
There are a few, obviously. With time, as I mentioned, markets should become more efficient. Expected events will be better reflected in the Bitcoin price. But until then, major price rallies typically draw attention. And looking back at previous market rallies, that there was, most likely a bubble effect going on at some point in each one of them. These are what I call moments when the market became highly speculative, where people were just buying for fear of missing out at practically in price. But, rallies also fuel interest it creates new projects, new initiatives. So it's not all speculative. It's not all explained by blockchain mechanics. Otherwise, Bitcoin will eventually fail. There must be a fundamental interest behind the rally or during a rally. And there are, of course, serious Main Street projects looking to leverage the cryptocurrency advantage. Cross-border payments, no third-party custodian. These are all, advantages that cryptocurrencies usually have. But, the main Bitcoin advantage compared to competitors is certainly its impressive adoption rate and the growing confidence around it. And being the first in this market has a clear advantage.
Yeah, I mean, I've definitely seen a lot of interest in the space around Bitcoin. And, and obviously there's a lot of the Bitcoin maxis that are, promoting and really advocating this, right? What are the most relevant indicators that could help us navigate the current or next bull run?
I come from from derivative markets. This is where I started investment banking. So I have a tendency to look at derivative markets, and some valuable indicators are provided, I think, by derivative markets. And when I say derivative markets, I'm talking about futures and options on Bitcoin, on the BTC USDT pair more specifically. And these instruments, futures and options, are quoted on major venues like the CME, so the Chicago Mercantile Exchange, or Deribit. So during the last major rally, at the peak in the final quarter of 2021, the put-call ratio, and I will explain what it is, the put-call ratio ended up above 90%. So it just means that there were more puts than calls traded. And puts are typically traded on the downside. So traders looking to hedge a risk on the downside will actually buy put options, right? So what that says, what the 90% is saying, is that traders were looking almost exclusively to hedge their downside exposure in the options markets. They would hedge downside for fear of a severe market correction. So the put-call ratio in itself, by definition, it's a value between 0 and 1. And the ratio above 90%, above 0.9, is really exceptional. If you look at the mortgage right now, this ratio is at 65%. So there is some kind of balance here. 90% indicated in the past that we were probably close to the end of speculative rally. It was, I think, one of the easiest indicators to read at the time. If it soars, it might be because, sentiment is shifting. Traders consider that the market is overpriced. So this indicator is not enough, of course. And I'm just going here over the very simple tools that worked in the past. But there is, of course, absolutely no guarantee that they would work in the future. Right? Another tool that I regularly look is the spread between the perpetual BTC USDT future and the spot price, the Bitcoin price. Perpetual futures are, very risky margin products. So basically, perpetual future traders would have a collateral in Bitcoins that they can pledge to buy these perpetuals for notional dollar value, US dollar value, that can be worth 10 times the value of the Bitcoin collateral. So they can leverage their exposure to the Bitcoin market tenfold. Right? Actually, in the widest scenarios, perpetuals can let users build a notional position worth 50 times the Bitcoin value they actually hold. But it's not free. First of all, it's risky because you run the risk of having your collateral liquidated if the market goes against you, and it's not free. If the perpetual future price is above the spot price, long traders, so perpetual future buyers, would pay a funding cost. And this funding cost can be extremely high. And at the peak of a bull market, this funding cost can reach 2% of the Bitcoin price per day. So imagine you have a long position in futures at the heights of the markets, you will be paying 2% of the value of your notional per day. I mean, we've seen it yesterday already get close to 1% on platforms like Deribit, but it can really get out of control. And this spread can indicate how speculative the market is, because holding leverage can be very expensive, and it's not unusual to see leveraged long positions just capitulate because they don't want to pay 2% or even 1%. So they sell their perpetual futures, and by selling these futures, they actually put a selling pressure on the market. And we typically have collateral liquidations that trigger a severe correction in the process. And this is what happened last Tuesday when the markets corrected by 14%. The market is currently extremely leveraged. We have an open interest in US dollars on futures with Bitcoin that are at a record level. And so seeing these market corrections, I think won't be unusual during a market rally.
I used to think with this whole Bitcoin and cryptocurrency market, it used to be so overwhelming, right? But, I really appreciate you distilling it down for us. And I'm so glad you agreed to be a guest on our podcast. Your input and insights have been incredibly valuable. And it's been a pleasure to have you join us. Thank you.
The pleasure is mine as well. Pleasure is mine.
Oh man, I am learning so much with this conversation. So thank you again for being here to really explain everything to us. And for all our wonderful listeners out there, I trust you found this discussion engaging. Remember to show your support by liking, subscribing, and spreading the word about this episode. Thanks for tuning in, and until next time, take care.